Right. So on behalf of Isle of Wight Council IT, our apologies on this. It's not the first meeting that this problem has occurred. I suspect it probably won't be the last. So good morning, everyone. Isn't it nice to see so many people here? I think at the audit meeting on Monday there were 4 turned up. Yep. So we're obviously far more popular than audit. Isn't that a good start? Right. Just to remind you, please to make sure your mobile phones are turned off or on silent, to let you know that we are being recorded. And I'm sure we've got a note of everyone that's here. There were some people we were expecting, including Michael Lilly, who are not here, and Debbie Andre, who we were expecting, who's also not here, which is rather strange. But there we are. We'll carry on anyway. Right. Item 1 of the agenda, the minutes. To confirm as a true record, the minutes of the meeting held on the 2nd of June. I should offer my thanks here to Vanessa for taking over that meeting. Thank you. Councillor Andre. You're slowly getting there. Are there any comments on the minutes? No? Would somebody like to? I wasn't there, so obviously I can't move. Oh. Right, so proposed and duly seconded. Everybody who was there on that day and judges them to be a true and fair record of what occurred, please signify. Anybody against? No, minutes are approved. Declarations of interest. You've seen the standard template which is on the front of the agenda. Are there any attendees who would like to declare an interest? No, no interest. Good. Item 3 on the agenda. Well, my mind is still bogged down in the proceedings of last night. So, plus having a broken rear molar, which cracked just prior to the session last night, which is going to be sorted out hopefully at 2 o'clock this afternoon. Item 3 then on the agenda, public question time. I gather we have no public questions.
No questions have been received.
And the public gallery looks remarkably empty. Right, so no public questions. On to number 4, reports from the local pension board. We have 3 of these. The first one is the minutes of the meeting on the 24th of March. The second one will then be the 2nd of July, and I think on both of those I'll pass over to Tracy if is not here. So I was going to invite her to speak to them. Is there anyone else who would like to speak to those 2 minutes? All right. Are there any queries on those minutes? No. Then I think they are what they are. We will note 4A and 4B, and then proceed on to 4C, the annual report. You've all received a copy of it. The issue here, I believe, that this is not the final version of them, and we were to receive the final version, which we have not received yet. Is that correct? So on that basis, I don't think we can agree them for publication, knowing that they are not the final version. So all I would propose there is that we simply note them for now, and also note that we're still waiting the final version. Everybody content with that? Good. Item 5 on the agenda, the annual report and the accounts. This is quite a substantive one. I'll pass over to Joe on this one.
Thank you very much, Chairman. Could I ask you to turn your, thank you. This is the draft financial report for the pension fund for the year ended 31st of March 2021. For members' information, the pension fund itself does not have to publish accounts separately, as the accounts are prepared as part of the statement of accounts for the Isle of Wight Council. So the pension fund accounts that are presented as appendix to this report will be an appendix to the council's full statement of accounts. However, the pension fund by regulations must publish an annual report and accounts by the 1st of December each year. So the accounts that are presented as appendix to this report are in statutory format and contain all of the necessary information required to be disclosed. The accounts as they stand will be part of the council's accounts and will be approved at audit committee in September, assuming everything goes well with all of the audits. And then the accounts will form part of the pension fund's annual report and accounts, which needs to be published by the 1st of December. So the pension fund has a separate external audit to that of the council. And the council's audit commences on Monday next week. And the pension fund audit starts on the 23rd of August. And both of those have an intention to be completed by the end of September, when the accounts of the council will be presented to audit committee on the 27th of September for adoption and approval. And then the council's accounts with the pension fund accounts appended will be published by the 30th of September. The pension fund's annual report will be brought to the November pension fund committee meeting for final and full approval, and then will be published after that meeting on the pension fund's website and published with the local government association as well. So the report as presented sets out the accounts and the financial information that's required. And at paragraph 13 of the report, you have a timetable for the completion of the various items as I've just outlined. And appendix 2 to this report sets out the content of the annual report and accounts, which we're in the process, as you can see, of completing, and Joe is completing and collating all of that information. We're not anticipating any issues with that at the moment. The pension board at their meeting on the 22nd of September will have a look at the annual report and accounts and look at the CIPFA, which is the Chartered Institute of Public Finance and Accountancy, checklist for the disclosure of items in the annual report to ensure that completeness and every necessary disclosure has been made. And then effectively you will recommend, or you will receive the annual report, the external audit opinion, and approve everything for publication at your 24th of November meeting. Obviously, there's a lot of information in there, and I'm not necessarily expecting you to have read every single word, and probably not even if you have understood every single word, but that's what Joe and I are here for. So if you've got any questions on the accounts in its format or the content, please, I'm very happy to take them now.
Thank you, Joe, and as always, very thorough and detailed explanation, so thank you for that. I just have one query, and I suppose in a way it's sort of playing devil's advocate here. According to the timeline, on the 24th of November, we received the external audit opinion and should approve the annual report for publication. What if there are any issues that come up from the external audit that we still have queries on? I'm looking at the completion timetable, item 13, page 34. Through the chair, if there are any issues with external audit, we will of course notify the committee members and board members as they arise. If there are issues with audit that means that the accounts can't be finalised, obviously it will be in the public forum because there is a legal responsibility for the council to publish by the 30th of September. That's an extended deadline this year as a result of the continuation of the COVID emergency regulations that followed from last year. We will notify you of any issues, and if there are any issues to delay, then obviously there is, to an extent, we can approve
you can approve the report for publication subject to the completion of the external audit. But the anticipation would be, if there are issues at the 30th of September, we would hope that they would mostly be resolved by the 24th of November. Otherwise, we will have to be in breach of the regulations, but not by not being able to publish by due deadline. But that will have been discussed and agreed at Section 151 officer level and at the auditors by that point.
Okay, thank you. Just to be clear, I'm not expecting there to be any issues, but I thought it was important just to raise that. Thank you.
Yes, I have a query, page 59. Are we expecting any more people to wish to join our scheme? Is the first question. And Bernardo's, Island Roads and Ventnor Botanical Gardens all have nil against them. I can't remember why, but if they have nil, why are they there? Thank you.
Thank you. Under item 15 on the agenda today, I'm going to provide an update on employers. So that will let you know about employers that are leaving or negotiating to join. There's some confidential items in there. In terms of, but as top level, we're not, there's only one, I think, employer that has joined after the 1st of April, and that is Accomplish, who are outsourced adult social care provider. So that's an outsourced member. In terms of those employers that have nil contribution, these are employers that have active members, so they are still in members being employed by these employers, but because they are basically pass-through arrangements, so they're arrangements where they've been outsourced organisations. Excuse me, I've got my reading and seeing glasses on and I can't do both at the same time. So they are pass-through arrangements, so there's a fixed fee within their contribution and they're finite life employers, but because they are in surplus, so because their share of the assets of the fund are greater than their share of the future liabilities, it's been assessed at actuarial valuation that they don't pay any additional employer contributions into the fund, because when their contract ceases, if they're in surplus, the fund has to pay them that surplus at the end. So the employee members of those organisations are still paying their contributions and having those deducted and being paid over into the fund, but the employer has been assessed at not having to pay any additional contributions into the fund because they are in surplus at the time of the valuation. So again, this will be reviewed every 3 years. The employer contributions are reviewed every 3 years. It's unusual that employers would be assessed at a nil contribution rate, and it's only because these are fixed term contracts that have driven their employers' engagement with the fund that has enabled us to say they are nil, because when the contributions cease under the new regulations, exit surpluses have to be repaid to the organisation, as in the same way as exit deficits would have to be collected from the organisation into the fund. So because these are pass-through arrangements and therefore the risk falls to the council as letting authority, employer, rather than the employer themselves, it's been deemed that the employer hasn't taken any risk to an extent in having volatile contributions, so therefore wouldn't necessarily need to benefit from any surplus at the end of the operation. So it's trying to reduce the surplus before they come to exit, if that makes sense.
I think so.
For members' benefit, that was a very whistle-stop tour and it's very complicated, but we are just coming up to a triennial valuation in March 2022. So at the 24th of November committee meeting, we will be bringing down colleagues, or inviting colleagues from Hyman's actuarial services to give a briefing on what the triennial valuation is, how it works, and throughout the period between the 24th of November 21 and the results being agreed in November 22, there will be briefings and explanations to all members of what the triennial valuation process is and how it works and how employers feed into that. Apologies, it is complicated.
We're happy with that explanation. Good. I was trying to listen very carefully myself. Just a note on that issue. Perhaps in the future, because I agree it can be a bit misleading to see the word nil, maybe in the future we could have a double star and a little note at the bottom if there are any nils going forward that explains what nil really means.
Yeah, absolutely.
Because it, from your explanation, doesn't really mean nil. It's nil for a particular reason for a particular time period. All right. Sorry. I think Steve Milford was next, and then I'll come to Councillor Andre.
Yeah, thank you, Chair. I've got a sort of couple of questions, observations, if I could. Firstly, on page 47, it shows the investment management expenses for the previous year was 6.2 million, and that compares to 1920 when we paid 1.9 million. So obviously that's a significant increase, and perhaps Joe could comment on that. And I'm aware that obviously we look at net returns over and above what we pay management expenses as the sort of true thing of looking at performance, but that is quite a significant figure to consider when we're paying that out, especially when you think that 22 million is the figure we paid out in benefits. So it's about 30% of what we're paying out in benefits is the equivalent of what we're paying out in investment manager expenses. And just my normal comment on page 61 about the salary increase rates that are used, 3.65% was quite a bit above what the employees' pay award actually was or is ever likely to be. Thank you.
Thank you on those two. I'll defer to Joe for the answer, but I think the question on the first one also came up at the local pension board already, so probably is the same answer.
I'll take this one. The investment management expenses for 2019-20 included a significant credit as a result of transaction fees that were incurred or rebated, shall we say, in terms of our global equity portfolio, as that was transitioned from a direct holding into the investment pool at Access. So we had a credit of some 2 million? Yes. About £2 million worth of investment transaction costs that were credited back to the account last year. So if you add 2 million on as a credit and then 2 million on as a 2 million on as a credit, you'll see that that would take us to about £5 million compared to £7 million this year. And the reason primarily for the £7 million this year is the increase in fees that we've paid as a result of moving into the pensions pool with our global equity, UK equity and diversified growth funds, all of which previously had a low base fee with a performance fee. So we paid a low base fee on our standard assets under management, and then there was should a performance hurdle be exceeded, there would be a performance fee paid on top of that. So that was how we were when we were direct holding, and then as we've moved into the pool, we've gone into a straight fixed management fee percentage, which is higher than our original base fee, but is lower than our base fee plus performance, if you see what I mean. But unfortunately, the outperformance hasn't happened. So we would have only been paying previously a low base fee. Now we're paying a slightly higher base fee, but we would save had the outperformance happened. And so therefore we have to make our fee assumptions based on an expectation of outperformance. So we've incurred additional costs as a result of Access. Does that make sense? It's not good, but it makes sense. And then, sorry, what was your other page, Steve?
3.65.
Page 61. Actuarial valuation, yes. So we do make it very clear on page 60, I think, in terms of the assumptions. Actually, on page 61 as well, there's an explanatory note under the financial assumptions that says pay increases shown are for the purposes of actuarial valuation only and are not a reflection of actual pay, what actual pay rises will be in the short term. So what we have to look at is an expectation of a return to normality in the long term over the period that the valuation covers. So we know that pay rises have been very small over the last significant number of years, to be perfectly honest. But we have to make an assumption in the valuation that at some point a level of normality will return. So the blended rate for the total period of the valuation is a slightly higher rate than is actually being achieved at the moment.
And does the 3.65 actually reflect some norm over a given period of time in the past then?
Possibly not, but we do at each valuation, the actuaries look at assumptions from the last valuation and history between last valuation and this valuation to reflect what the differences were, and they'll factor that into the calculations that are made for future valuation. I believe, I can't remember off the top of my head, forgive me, the assumption is, I think, 1% for the next 3 years in terms of this valuation period, but I'm not sure if that's exactly right. But then an assumption that at some point there will be a baseline, a CPI plus inflation rate for salaries. If we factored in low salaries forever, effectively, we run the risk of making under assumptions of contributions and therefore having to charge higher employer contribution rates or require higher investment contributions. If we make an assumption of higher pay rises, we can review that experience every 3 years and make those adjustments. Does that make sense?
Thank you, Jo. Councillor Andre.
Thank you, Chair. Back to page 59, just the usual reminder, Sandown Bay Academy has not existed for 3 years. It's the Bay CE. Thank you.
Absolutely, but at the valuation in 2019, it was still an employer. There was still an employer at the time that the valuation was completed. Sandown Bay Academy was run by AET. At the next valuation, Sandown Bay Academy will cease to be on this list because it will still have members of the pension fund when it was Sandown Bay Academy, because those deferred and pensioner members that happened in between Sandown Bay Academy being created and Sandown Bay Academy closing are still the responsibility of AET.
Okay, so will it show two? Will it show both? No?
It won't, because the Bay C of E is part of the council.
Yes.
So it will be shown as the Isle of Wight Council's contribution rates. It will not have its own independent contribution rate.
Thank you for that, Jo.
So are there any other questions or observations on this item? I think we seem to have exhausted everything.
Exhausted Jo, I think. That's a start.
No, Jo's stellar, I think, on this. Thank goodness. Okay, we come to the end of this section then, and I think with that note about the completion timetable, the only thing which needs to be added in there is we still don't have the board's annual report. So at some stage we will get that. And I hope that will fit in with our other timetable obligations. If we can then come back to the end of section 5 in there, we have a couple of recommendations and I'll take them one by one. The first one is to approve the draft accounts for the year to the 31st of March. So moved. Do I have a seconder? I think Ian was nodding just a moment ahead of Debbie. All those in favour? Anyone against? That's unanimous. Thank you. And the second one is to note the progress on completion of the annual reports and confirm the timetable, which we've just discussed. Is there someone who would like to move that motion? Councillor Andre, do I have a seconder? Councillor Ward, all those in favour? Anyone to the contrary? Nope, that's unanimous as well. Thank you. Right. The next one is to come on to item 6 on the agenda, for which we are all going to have to turn and face the small television and perhaps put on our long distance glasses at this moment. Now,
Can you
I'm
hear
assuming
me?
we have to do something clever here with the audio, do we, to get it working again so that both sides can hear?
I think we should be okay. Emma, are you, can you hear us and are you ready
Can
to go?
you hear me just now? Is
Yes, I think we can.
it faint?
We're going to try and turn the volume up just a second.
Okay.
We've had some, yeah.
I'll try and speak loudly. Okay, are you happy for me just to go, Joe?
Yes, I think so, if that's all right.
Yep, no problem. I'll just give a brief market background on investments in general and then cover off performance and estimated performance of the fund, funding level, and then go on to give you a few updates with managers prior to your presentation from Baillie Gifford. So at a macro level, global growth markets were positive over the quarter as vaccine rollout gathers momentum across most developed nations and countries further ease lockdown restrictions. As those lockdown restrictions ease, economies are becoming more resilient to the effects of COVID-19, and that's had positive effect on global growth markets. So we have seen things like stock markets rise over the period, and the US have also implemented further fiscal stimulus, which has supported markets. So pumping money into the economy to keep everything growing and afloat. Q2 global growth expectations continue to improve. So forecasts for global growth keep rising and anticipated to be close to 6% global growth over the second quarter of the year. And that's as economic output from companies starts to return to what we've seen as pre-pandemic levels. And what that equates to into numbers is that global stocks were up about 7% over the quarter and up 25% over the year as a whole. And that's in contrast to the UK that still lags global growth, so up 6% over the quarter and up 18% over the year as a whole. That's a quick reminder as well of the decision to restructure some of the equities within or stocks within the fund's strategy. We're going to come out of UK in favour of global and just rebalance some of that overweight position to the UK, reflecting some of the more modest growth that we've seen in the UK environment versus the global environment. The US, whilst putting more money into the economy, did also announce that an interest rate rise could happen sooner than markets were anticipating, which caused government bond prices to increase and the yield on them to fall, and that impacts on your liabilities. So as the yield on government bonds decreases, the value of your liabilities increases, so that will reduce your funding level, all else being equal. Within UK property, this property experienced its first month of positive growth since the pandemic in May. So office and retail sector values are still remain down, but the pace of decline is slowing and kind of rolling 12-month metrics within the property market are looking much more improved and positive than they were this time last year. So what does that all equate into performance of the fund? Well, it's anticipated that the fund has increased in value by about 5% over the period, reflecting positive growth pretty much across all of the mandates that you've got. We estimate that the fund is now worth 721 million versus 685 million at the end of the previous quarter. So up that 5% there. And then what that translates to in funding level, you ended Q1 around about 102% funded, and you're also ending Q2 around about 102% funded. It did bob around over the period because yields fell and your liabilities went up, but then your assets also went up. And so you were about 106% funded a couple of weeks ago, but you're settling around about broadly similar to where you ended the previous quarter. So that's all I was going to say on investment returns and the mandate and the fund's performance. But do you have any questions before I go on to some changes that happened at Newton?
Don't appear to be any questions, Emma, so if you'd like to move on, thank you.
I'll just pass to David if he's got any comments as well.
Yeah, I just wanted to make a quick comment on inflation. So something that's covered in our brief update note, but I know there is kind of greater speculation or concerns about higher inflation coming through. And we've got a kind of separate article that we can circulate on that. So we are expecting to see, with the economies restarting and kind of bouncing back from the kind of baseline effect, that we'll see high inflation throughout the rest of this year. But market consensus is still for inflation to kind of recede again into 2022. But certainly we are conscious of more of a kind of upside risk related to kind of higher inflation levels. But some of the strategic changes that we're making to allocate money to areas like infrastructure, whereas a greater inflation linkage should put the fund in a better position if we do see higher inflation. So it's the only thing I wanted to add, Emma.
And it's worth pointing out as well that over the past month, it's not reflected in any of the reports. We did make our first investment to the infrastructure mandate, thanks to Joe for all our hard work to get that across the line and to meet the closing date. So the two new mandates that were appointed, private debt and infrastructure, now do have assets allocated to them, and they will continue to grow over time as more and more money is drawn down by the managers there. So in terms of your existing mandate,
Emma, sorry, just one.
no, on you go, Joe.
Councillor Churchman.
Yes, a couple of questions. One of the biggest problems is going to be lack of supplies, which will slow down the regrowth of the economy. For example, plastic for double glazing. I'm told the waiting list is colossal. Also, oil is still staying around $73 a barrel. Do you expect that to go up? Because after all, oil is used for plastics of certain types. Just where do you see this? You know, is this going to cause greater inflation? Thank you.
Thanks, Councillor. So certainly, I think there are increased short-term pressures round about inflation. So yeah, definitely over the next 6 months, we do expect to see that higher inflation. I think beyond that, I think there's greater uncertainty as to how that might come through. So we think there is more upside potential for that inflation to come through, Councillor. But the general expectation is that we will see supply chains start to get back to normal as we move into 2022. So still uncertainty, but they think that the expectation and consensus for that to return a bit back to normal. In terms of the oil, I think it's always very hard to predict what's going to happen to the oil price. You know, the supply, both the supply and demand side of that equation. So it's just ensuring that, you know, we've spent quite a lot of time recently focusing on the oil and gas, the carbon exposures within your portfolios, and making sure your managers are doing their job and understanding what the risks are and positioning your portfolios accordingly.
And what we've also seen is a lot of major economies adapting to things like the short-term delays within the supply chain. Even in Scotland and the UK, they are starting to allow people that were isolating to go back to work, whether if they are working in essential services like supply chain, providing that they can produce negative tests, etc. So people are becoming, the economies in general are becoming more resilient and finding ways around these short-term delays that we are getting, which is kind of bolstering positive improvements within markets.
Can I ask a question? Can you tell us what you think is the likely impact going forward of the continued discussion of trade between the UK and Europe?
I think in terms of the shorter term expectations, you know, I still find it hard to assess, you know, how the growth of the UK might compare to globally. Certainly, we do expect the UK economy to grow at a slightly lower rate than the global economy overall, which has been part of the rationale to not come out of the UK entirely, but reduce the overweight that you have relative to other global markets, and particularly areas like emerging markets where we may see higher levels of growth. And again, it's really just focusing on the way that your managers are positioned. You might see reference to kind of old economy versus new economy areas. where they're kind of more exposure to some of those carbon intensive areas, and some of the changes that we're making have been shifting the allocations to allow for some of those expectations. So overall there's slightly lower expectations of growth in the UK relative to the global market, and we've been adjusting the portfolio weights and the strategy to allow for that.
Any other? Joe, any questions?
I would just like to say to committee members, those questions that you've just asked might be useful to also add to the list for Bailey Gifford when they come in at 11 o'clock, to just ask some for the fund manager's view at that point. I think that's probably all for questions on this bit. Emma and David, did you want to just give an update on Newton, please?
Yeah. So as a reminder, Newton are the investment manager that manage your global equities, and they manage them on an active basis. So the manager goes out and tries to pick stocks to beat the market. And there's been a lot of significant turnover with their portfolio managers at Newton and in senior management at Newton. This has been happening over the past couple of years. But a man called Jeff Monroe, who some of you will have met, was a portfolio manager on the Newton Global Equity Strategy, and it's been announced that he will be leaving the firm at the end of the year. And it's important within an active manager that you have consistency within the portfolio team and the management team, because you are relying on that expertise to pick the stocks that are in your portfolio. He's leaving to pursue another role within private markets within the investment world, but they've not announced a replacement for him at this time. Instead, they're going to gradually pass his responsibilities on to other members of the team. So there are 4 other portfolio managers within the team, 2 of which have been there for quite a long time and 2 of which are newer. And in addition to Jeff Monroe's resignation, Newton have announced also that their Chief Investment Officer, Kirk Custard, will also be changing roles. And this all came about because Newton and its kind of parent company BNY Mellon were coming together, and there was 2 CIO roles, and they decided to work together jointly, but obviously that's not happening anymore, and Kirk Custard has decided to take on a different role within the organisation. So Newton have stated that as a personal decision, but they are now looking for a new CIO of multi-asset investments there as well. So this is just adding to a list of numerous personnel changes at Newton over the last couple of years. And so it's important just to note the significance of Jeff Monroe leaving. He's been an important member of that team for a long time. He previously held the role of CIO at Newton from 2001 to 2012 and has been involved in the portfolio for nearly the last 10 years as well. And this was following the departure of somebody called Raj Shant, who was another important portfolio manager in 2019 as well. So we do have some concerns over Newton's ability to retain top management talent, and we'll be keeping a close eye on this. Currently, they are still rated positive, but on watch closely by our research team to see how these changes are embedded. We would hope that within organisations such as Newton, that the process of selecting investments is so embedded throughout the team that it can handle churn and turnover within personnel, but there has been quite a significant amount of that over the last few years. So that's why we remain with this mandate on watch. And we will update you should we have any further concerns, but our research team will continue to meet with Newton regularly. And worth pointing out that we are coming out of Newton to fund some of the other mandates. So we're trimming that position to them as well. And that was all part of the strategic decisions that the committee made to trim your allocation to active management. Currently, all your equities are managed by active managers, but you made that decision to go into the passive UBS fund to take away some of that risk that you have with your equity securities.
Just to say, I will be inviting Newtons to attend the Pension Fund Committee meeting on the 24th of November, similar to Bailey Gifford attending today. So members will have the opportunity to ask questions as raised by Emma. But should anything develop in between now and then with the Newton situation, we will obviously keep you updated as soon as anything happens.
Steve Murphy. One more.
Could I just ask a very quick question on that? Just hypothetically, if Newton's performance did nosedive and your faith in them plummeted, what in practical terms could and would we do?
It depends on how bad it gets and if there's further portfolio turnover. So they are still rated positive on watch. If they were to deteriorate further, they might just be downgraded to suitable. And then further downgrade would be negative, and that is we would put no further new money with them, and we would consider alternatives to moving that money. Now, that's not a light consideration given the transaction costs, the time and cost associated with a manager selection exercise. So it really would be having to see the impact that it has on the portfolio management. Just now, the mandate is still being managed well and performance is fine. So unless there was significant changes to that, but if it deteriorated rapidly enough, then we could, in the extreme, look for alternative portfolio managers to manage that allocation, but that would be a last resort.
There's also some additional considerations just with the access pool, where Link as the operator will continue to monitor the suitability of the managers for the sub-funds. So there will also be work by Link in terms of whether they're happy retaining Newton as a manager of one of the sub-funds that you're invested in. And you have also other sub-fund options that could be considered on the access platform as well.
That was
Joe.
That was pretty much what I was also going to say in terms of the access pool. So we don't have a direct relationship with Newtons anymore. We have a relationship with Newtons through the access pool. There will be members of the access pool invited to a development session or the committee meeting on the 24th of November, which is looking like a really busy meeting at the moment. So at the next officer working group meeting for access, I will raise the issue of Newton with Link. I'm sure they're aware because they've forwarded a copy of the email through to me as well about the changes. But as David mentioned, if Link decide to cease offering Newton as a portfolio as a sub-fund on the pool, that's one consideration which will impact everybody in the pool. If we locally decide that we don't want to be with Newton, we will be able to withdraw, I believe, our funds from the Newton pool and put them into a different sub-fund within the access pool, subject to advice from Hymans. But at the moment, as we've mentioned, it's on watch. It's still a positive provider. Should the situation change dramatically, we will obviously keep a very close eye on that, and decisions will have to be made at this committee rather than outside of it.
Any other questions? Oh, well, I think we'll thank Emma and David. Thank you very much for today. Item 7 then on the agenda. We have an update on the local government pension scheme. Joe.
Thank you. This is a huge part of your agenda pack, for which I profusely apologise. The issue that we have is there are a lot of things going on in the LGPS world at the moment. And the easiest way for me to keep you as committee members updated about what is going on is to circulate the bulletins from the Local Government Association, as well as a number of other items that come through during the period in between meetings. I had previously, in a previous committee, these were emailed out, recorded on the agenda as having been emailed out, and then as part of that agenda item, key items were drawn to members' attention. My current thinking, and this is just me thinking, so forgive me on this one, is that because there is so much happening, to draw attention to them as part of the agenda pack and highlight key items may be the better way forward. Unfortunately, it does mean that the pack is huge because of all of the appendices being reproduced. So I guess my question really is how members of this committee would like to see this information presented, provided and discussed at the meetings. There's nothing really significant in any of these items at the moment, other than those that are kind of highlighted in the covering report, which I don't propose to go through in detail unless there's any questions. We are still awaiting a lot of activity from MHCLG issuing regulations on the final McLeod remedy, which is the age discrimination remedy for transition in between schemes. On the good governance project, the guidance that's coming out from that, there's also expected to be some guidance on further guidance on pooling and further guidance from from MHCLG on responsible investment activity. So those are all key issues that we need to be focusing on, but we're waiting for Parliament to receive those informations and circulate them through. So really, I think there's a lot going on. There will always be a lot going on. There's a lot of information to share. This is sharing that information. I'm very happy to take any questions and also to take suggestions as to how this agenda or these agendas are taken forward in future.
So I think under this one, we have a choice. And I don't think we can get into, you know, half of us receiving it by email and half of us receiving it by paper. I think that's simply too complex to manage. I think we have to either agree to all receive it by email or all receive it by paper. And bearing in mind, it is an extremely active topic and it's already quite a chunk of paperwork. Are you happy to get it as a chunk of paperwork, or would you rather get it as and when it occurs by email? That's the choice. I'll take suggestions on that. Councillor Andre.
I think as a responsible organisation, we should be moving towards email anyway. And as you've suggested, Chair, I think it would enable us to get more up-to-date information. So I would vote that we receive updates by email.
Councillor Quigley.
Yeah, I agree with Debbie, but is there a way of including exception reporting within it? Because the danger is we go, oh, there's another 72 pages, absolutely fantastic. But if we had a grid at the front that said, look, pages 8, 9 and 12 require action or acknowledgement, maybe that might be the way.
What we could do, sorry, I'm still on. What we could do is for the items that are coming out on a regular basis, just to receive them all as emails. And for the ones which have some noticeable, you know, some urgency or some other criticality, we can use that nice big red asterisk, which we get on some of our emails.
And what I try to do, and I say try, but there's only so many hours in the day, unfortunately, when these bulletins do come through, is I try to summarise them and identify key items for your attention as I circulate them round. You'll see on the front piece of the agenda there is a list of items circulated for members' attention, so we can highlight those, and you can try and again update that list for every email I send out. And unfortunately, some days there are 5 or 6 emails that come out, and some days there won't be any. Hooray! But what I can do then is summarise as I distribute the emails the key items for your attention there, and then if there is anything that is fundamental that has developed, I could do a summary report without representing the appendices, but highlight those items that have been drawn to your attention throughout the period between meetings. Is that acceptable?
Councillor Ward. Yeah, I'm fine with that. So,
just one thing, if we get graphs, then can they please be made at a readable? Because very often they come up on your screen and they are extremely small and it is difficult to understand the numbers or even what it's talking about. Thank you.
I have the same issue. And it's not just the glasses, it's my screen simply refuses often to scale them. And I think sometimes it's the nature by which they're imported in from another source, whether they're scalable or not. I don't understand the difference of the technology by which that happens, but clearly an issue. So it seems as if we're broadly happy with that, with the caveat that Joe's just added to it. Everybody in agreement with that? Good, we'll save a lot of trees.
So in that case then, have members got any questions on the plethora of information that's provided under this item?
Right, so we'll note that then. Thank you very much indeed. On item 8, we have a verbal update on contract management. Jo.
Thank you. Eventually you get fed up with me talking. But you've got to put up with me for a little bit longer, I'm afraid. So contract management, I was intending to provide you with a list of all of the contracts that we've got outstanding with the pension fund, but I ran out of time, so unfortunately I haven't. So just to make you aware, there are a significant number of contracts. We've got a custodian, actuarial advisors, governance advisors, investment consultants, benchmarking, administration software, the pool, and those are just the big ones that I could think of as I was listing them the other day. So we use a national framework where we possibly can to procure those activities. The national framework is developed by the local government pension scheme through Norfolk Pension Fund for local government pension schemes to draw down, and it significantly reduces the amount of work that each local authority has to do in terms of procuring these contracts, and shortens the award period quite significantly because a competition has been run for those suppliers to get onto the framework, so they are all deemed suitable to deliver the services. We then just have to do a local mini competition effectively to procure to our specific specification. I will circulate to members a list of those contracts that we've got, but the key activities that need to happen over the next 12 months, which will be factored into the work plan. We need to look at the 2 benchmarking contracts, one of which is investment management costs, which is a national benchmarking activity to determine value for money, and also investment performance, which gives league table presentation as to where we are compared to the others, other local authority pension funds. Those 2 contracts, I think the framework is being extended, so we need to look at that and whether we determine to continue on with that or not. The governance consultancy contract, which is with Hymans Robertson, is coming up for the end of its initial period at the end of January 2022. There is an option to extend on that contract, so I propose to extend that contract because the support we've provided has been excellent. So I propose to bring a report back to the November Pension Fund Committee with a recommendation to extend that contract. And the biggest piece of work that we've got to carry out is the reprocurement of our administration software provider, which the current contract expires at the end of December 2022. Having been extended a number of times outside of the existing contractual arrangements with agreement with procurement, simply because there is not enough hours in the day to complete that work and do all of the business as usual work and all of the additional administration work that's going on at the moment. So Matthew and his team are leading on that procurement activity, and we will be inputting into that. There is a national LGPS framework for that, so we won't have to do too much contractual work as such, but we do need to make sure we've got an appropriate specification for that software, its requirements, etc. We've got until December 22 to complete that, but obviously the risk with a reprocurement is that we don't end up with the same supplier. So there is a transition activity that may or may not need to be required. We cannot preempt the result of that procurement. So we're looking at making a decision, hopefully late summer 22, so that we've got time, should we need to transition between the award date and the ceasing of the existing contract. We will keep you up to date with that. It is unlikely that there will need to be committee involvement in that procurement as such, because it is an operational activity. But some of the advisor contracts, the governance, actuarial, investment advisors, etc., we may seek committee engagement in some of those procurement activities, in the selection activities, because obviously the advice is coming to you as committee members. So we need to make sure that you are happy with the supplier that comes through. So really just to say, contract management will become an item on the agenda, maybe as a standing item, either with nothing to report or activity to note. But there is a lot of activity that will happen over the next committee cycle, and particularly probably over the next 12 to 18 months in terms of those contracts. Happy to take any questions at this point.
So, and then briefly on knowledge and understanding, Joe, and then I think we've got another session due to be joining us on the television.
Did you want to defer the knowledge and understanding bit until after the investment managers have spoken?
Is it a short item or?
It can be a very short item.
Let's make it a very short item.
I'll make it a very short item. After the last committee meeting, and sorry, I've written my notes sideways, I circulated around to members a link to the TPR, the Pension Regulators Toolkit online, that's got 7 modules of information about public service pension schemes in general. I just wondered if members had had a chance to look at that and done any of those activities. Obviously, Richard, I emailed to him yesterday, so I'll give him an excuse for not having done it just yet. I will send it again, yeah. Right, okay. I will re-email it to you, to Ian, and make sure that I remind you. But we did say, I mean, ideally it would be a useful activity to get that done. If you could get those modules done within sort of 6 months of joining the committee, they will give you a background into the public service pension scheme. Not necessarily the LGPS and definitely not the Isle of Wight Council pension scheme, but overview. The next thing is there is a Hyman's LGPS Online Learning Academy, which has just been launched, that is a number of specific LGPS learning modules, again online with a video tutorial and then a multiple choice. And at the end of both of those, the TPR toolkit and the online academy, there will be certificates that you can print off and share with me. I haven't yet circulated the Online Learning Academy information. We've got 10 licenses initially. We are going to need more, but I wanted to just get 10 to get it out to a number of people. So I'm thinking I will do one of those licenses. I'll probably share a number with committee members and possibly with a couple of the board members as well, so that you can see what the system is. And then we'll roll it out. And then just again, with all of the various emails that are coming through, webinars and briefings, be aware that they're happening and come in and join them when you can at your own speed. And we're looking to book a lot of development sessions outside of the committee cycle. So I sent emails recently about governance decision matrix training on the 7th of September and risk management training on the 6th of October. I've checked your diaries and they were empty, so I've slotted the time in. So more for you if you haven't updated your diary. I will intend to record those sessions and make the links available. But they will be factored into the work plan. There will be a lot of training and development because as a new committee with a lot of new members, there's a lot of stuff that we need to do quite quickly. So there's a lot of information that I need to get into your heads now so that you can do and make your decisions appropriately. So please do the toolkits. Please go to as many webinars as you can. Please attend the development sessions and please just contact me if you've got any questions. I'm really happy to provide overview briefings. I'm happy to talk things through. If I don't know the answers, I know people that do up in Glasgow. I also know a lot of people in the LGPS world who will be able to help. So please, this is important. There is no statutory responsibility at the moment for pension fund committee members to have a required level of knowledge and understanding. There is a statutory requirement at the moment for board members to have individual level of learning and knowledge. However, with the Good Governance project that's coming out, there is a move to make more requirement for committee members who are the decision-making body of this fund to have that level of knowledge and understanding to be able to do their jobs properly. So get in while you can. Let's do it while we can do it ourselves and not have it done to us. But again, please, can I just encourage you as much as possible to do as much outside learning as possible and ask me if you've got any questions. Thank you.
Thank you, Joe. You might also want to consider the 12-day intensive deep dive training at Aston University on public sector pensions and finances. I don't know what deep dive means, but it is 14 hours a day for 10 days. So I'd imagine they cover quite a lot. And you can do an annual 1 week refresher, which is 6 days deep dive. So if any of you... No.
Please note that this is not necessarily a recommendation from the Pension Fund Committee. This is a chair.
No. Aston, yeah, so 12-day, they call it a deep dive training, public sector pensions and finances. Yeah. Yes. It's only 12 days, Vanessa. Sorry, I think Barbara.
Yeah, it's just a question for Joe. Were you able to circulate that link on that webinar? Because on the fiduciary duties sitting alongside responsible investment.
I haven't done yet, but I will do that.
It expires today, but I have been in contact with him, and it's a firm of solicitors that put on that session, and they may be happy to supply it to us as a training webinar.
Thank you, Barbara.
Right.
So, hello, Tom and Barry from Bailey Gifford. I think Emma are you able to do a very quick introduction, and then we'll hand over to Tom and Barry. Members have a copy of the presentation, the slides that were circulated from Bailey Gifford. And so I'll hand over to Emma and then hand over to Tom and Barry. Thank you.
Yeah, I was just going to give a brief introduction to remind the committee that the Bailey Gifford mandate is a diversified growth mandate, so aims at producing investment returns that are growth-like in nature, but invested in lots of different asset classes. So not just equities, for example, you're invested in property, infrastructure, credit of all different types across global markets as well. So just as a reminder of what this mandate tries to do, and it tries to generate positive returns of about 4% per annum above cash rates, and Bailey Gifford have been successful in doing that. They have been above benchmark and target over all kind of recent time periods considered up to the last 5 years. They're currently rated preferred as one of our preferred managers in the diversified growth space, and we have them as a responsible investment rating of good. You remember the ESG report that we produced and carbon metric reporting that we produced on the fund's portfolio, which highlighted a few things that I think will be raised with Bailey Gifford today that Joe has been in touch with. So just to note as well that the carbon intensity of the portfolio has reduced by about 15% over the last 5 years. And there's a few areas in which a diversified growth mandate would invest, which is different to an equity mandate, for example, in property, commodities, infrastructure, and these asset classes in general have a higher carbon exposure than listed equities. And that's why you see some of the differences coming through within the diversified growth fund mandate. But within the sectors that Bailey Gifford invest, they have picked particular investments that are lower in carbon intensity than the index as a whole. It's more just as a construction of how a DGF mandate works that gives you that higher carbon exposure than a traditional listed equity mandate. And there's a couple of names that I'm sure that we could ask a few questions to Tom and Barry about. But other than that, I was just going to pass across to Bailey Gifford to fire away.
Okay, thank you, Emma. Very good to see you all. So I'm just going to talk a little bit about Bailey Gifford and update you on what's been going on here, and then I'll hand over to Barry to talk about your portfolio, but we'll keep it quite quick to leave lots of time for questions and make certain we cover the ESG factors. Now, the Isle of Wight Council, you appointed us back in 2013, so many thanks for your support over all of these years. There's been very little change to the firm in some respects since that time. We're still an independent partnership with no outside shareholders, and we think that's a huge advantage in uncertain times such as this. When we can sit with no outside shareholders, we can stay focused on our business and on investing your money without having to be concerned about what other shareholders might want to do. It also means we're focused very much on investment opportunities, which Barry is going to be talking to you about. I hope we've been delivering for you since you appointed us back in 2013, not just in terms of performance, which has been certainly in line with the targets which Emma was outlining, but also in terms of the changing views on ESG, and that's something we've been investing a lot of effort into over the years, partly in response to demand from clients such as you. So we now have 24 people in our ESG team, including some very experienced specialists in areas such as voting, carbon, the environment, social impact, and other topics like that. Happy to go into more detail there. And the other point is, obviously, when you first appointed us, it was as a standalone mandate, and it's now pooled through the Access Fund. And obviously, we're working very hard with Link to make sure that the reporting is as good as it always has been. But also, in terms of costs, I think you have benefited hugely from that. £115 million mandate, which is about what I think you've got with us at the moment, back in 2013 would have had a fee of about 0.5%, so probably about £600,000. Now, with the benefits of scale that pooling has given you, and also with some fee cuts, which we've been making over the past few years, and that has come down by about a third, so £200,000 worth of savings per year from us. And I hope that's helped you achieve some of your objectives with pooling. If you flick onto page 2, that just shows, as I mentioned, the investments we've been making in increasing our capabilities. The multi-asset and fixed income team who manage your portfolio are in the bottom left, and you can see that they do benefit from all of the other investment efforts across the firm in equities, fixed income, currencies, for example. And on the right-hand side, some other quite interesting stats. I think the points I'd draw out is firstly that the investment teams are still extremely experienced, with average experience of 23 years for the heads of the teams. It's very stable with low turnover, so investor turnover is below 5% per year. It's very aligned with you, when we try to create the bonuses and how to reward our fund managers. It's on 5-year rolling performance, so genuinely on the long term, which is what we think matters with pension funds. And finally, it's increasingly diverse. I think when I first went down to do the sales pitch for almost a decade ago now, Baillie Gifford was a good deal whiter and more male than it is now. We have 53 different degree disciplines and 27 nationalities across the investment floor. So really trying to get in different views into the debate. But with that, I'll just pass on to Barry to talk about the Diversified Growth Fund and the performance and where we stand.
Okay, super. Thanks, Tom. And good morning, everyone from me. I hope you can hear my comments clearly. Please do let me know if that's not the case. There were 3 points I was going to cover over the next 10 minutes or so. One was just a very high-level description of what it is we're aiming to do on your behalf, just to recap a few sort of high-level points underpinning the Diversified Growth Fund. Then just to touch upon recent performance, though perhaps more interestingly, our view of the world, how that translates through to the portfolio. And then finally to reflect upon how ESG considerations are a fundamental building block of the Diversified Growth Fund. So a little bit to get through, but please don't let that stop you from asking questions as I go. Turning to that first point, just a high-level description of the Diversified Growth Fund is on page 3 of the handout, if you have it there. Here we're illustrating the 4 building blocks, if you like, that underpin our investment philosophy and process. The first, arguably the most important point, the team. We are fortunate, as Tom has alluded to already, that Baillie Gifford people generally find the company a good environment to work in, a challenging one, one that encourages diversity of thought, encourages robust conversations, but also one which lets people get on with the businesses doing ultimately what is best for our clients. That has helped us to build a very experienced team responsible for managing the DGF, but importantly, one also that has at its disposal, as you saw on the previous page, all of the resources within the wider firm to draw upon. It's perhaps the rather clear and obvious goal of building a portfolio which embraces diversification, which looks across a genuinely broad range of different asset classes in order to deliver good returns over the longer term, and for those returns to be delivered in a relatively smooth fashion. Some of those more well-known assets, as Emma mentioned, listed equities and government bonds, but also the likes of property, infrastructure, commodities, a whole lot more besides. What we spend most of our time thinking about, our research starts with the big picture question of what state is the global economy in, and which direction is it heading. Those bigger macroeconomic themes, government policy decisions, demographics, climate change, more latterly, of course, the impact that COVID-19 is going to have on the global economy and to a reasonable degree on different regional economies. After that, we do think about valuations, what's attractively priced and what isn't, quite simply. And again, apologies if this is perhaps a rather clear and obvious point to make, but we're more inclined to own things which are relatively cheap than are relatively expensive. Other considerations come into play, of course, but valuation often works pretty well as a starting point. But taking each of these points, the team, the opportunity set that we have, our views of the world, it's from each of these that we look to consistently build the portfolio. It is a growth-orientated portfolio, but not growth at any cost. We see the benefits of a diversified portfolio being our ability to deliver good returns over the long term, but to do so without experiencing too many big bumps in the road. We cannot rule out that volatility. It's something that you have to embrace within the portfolio to a reasonable degree, but it's very much accepting the dual mandate that we have for the portfolio. So that's the sort of high-level summary of the key principles underpinning the DGF. I'll turn now to page 4, and I won't labour on this page, but just a few points from here. From a broader fund perspective, the message with regards the team managing the fund, it's very much one of consistency. No recent changes to report with regards to the key individuals and decision makers within the team. There will be a small change coming up with regards to the analysts in the team in the coming month or so, as part of the regular long-standing investment graduate program in place across the whole of Baillie Gifford. Both Callum and Wight that you see on the page there, they will rotate off the team in September. It's very much a mutually beneficial process. It's great that we've got Callum and Wight in the team. They bring fresh ideas, fresh energy. But then it's also good that they rotate and go into different teams across Baillie Gifford. They can be our scouts and our sort of eyes and ears across the different strategies. They still report some ideas back to us as the years go on. And that's been something which we've experienced over time. But again, come September, we'll get new analysts coming in, and again we get that great sort of new bit of energy coming in. Just one other point to note here: we have recently reopened the Diversified Growth Fund. It closed back in 2013, but in that 8 years, the capacity within investment markets, which is the reason why we closed it 8 years ago, but that capacity is now that much larger. And therefore, the ability for the fund to utilize, quite frankly, that extra capacity is once again there. Crucially, it's there without creating any problems of any sort for existing clients in terms of how we manage the fund. That has always been our key focus: what's best for the existing clients, and then how can we work from there. With regards to performance, there are a series of numbers on page 5, I think, to reference. The headline here is that in line with the objectives we have for the portfolio, the longer term performance of the fund, the 5-year annual returns, which you'll see in the box on the right-hand side of the page, 5.1% per annum net of all costs is ahead of the target return, which over the same period is 3.9% per annum. And the other objective, the delivered volatility, which essentially offers an indication, if you like, of how smoothly those returns have been achieved, at just under 7%, again, over rolling 5-year periods, that clearly sits well underneath the upper limit we have in place for the fund of 10% per annum. There's a little bit more granularity on how that performance number in the last 12 months has been generated, and Again, I don't want to labour on this, but I do think it provides just a little bit of useful context for where we are now and where we might be heading from an economic perspective, at least. Just to talk you through this image that you have on the page there, the green bar on the right-hand side of that graph, that is the overall portfolio return for the 12 months. And then to the left of that, sorry, was that a question?
Yeah, sorry, we've got the handout in black and white, I'm afraid, so we can't see the green bar. Sorry.
All right, okay. Well, the bar that has 14.5% on the far right-hand side, if that helps. Apologies if it's in black and white, but I suppose the colours are helpful just in terms of trying to break down the individual asset classes, but they're sort of listed on the bottom of the axis anyway. The few key points which I think stand out from the last 12 months. One is that most asset classes have delivered some form of positive return, and that's clearly a good thing. The other is that the real standout performer in the last year has been listed equities, and that is the bar on the far left-hand side, which has 9% written above it. That is the contribution it's made to the overall portfolio. It's really actually since the end of March of last year that the sort of the overall positive economic environment, which has to a large part been sort of greatly fueled by very accommodative policies from government, central banks, an environment of low interest rates, generally low inflation. This has been good for equity markets in general, and equity indices around the world have clearly benefited from this. The other factor contributing to performance for our equity allocation that you see here is the good additional contribution generated by the fund's allocation to our in-house equity funds, which have beaten their respective benchmarks by a notable degree, and that's really due to their exposure to many of the companies that have quite clearly enjoyed an acceleration of some of the longer-term trends which have been developing: the shift to e-commerce, technology adoption, electric vehicles, medical advances to some degree or another, the extent to which economies and societies all over the world have had to adapt to this, quite frankly, rather strange world we've all been living in for the past year or so. It's not all been equities. Still a good contribution from property, from infrastructure, from commodities. The commodities is gold, silver, and nickel. Gold being that bit more defensive, and nickel as a metal which is heavily utilized in electric vehicle batteries, and silver sits somewhere between the two of them. Infrastructure has greatly benefited from exposure to renewable energy producers. The companies responsible for getting that green energy onto the grid, and the way in which many of the larger economies around the world are gearing up for a concerted push towards very ambitious spending plans to combat climate change, arguably the biggest challenge facing the world in the years ahead. I'll come on to talking about that in a bit more detail in just a moment. Again, though, not to go through each and every one of these asset classes, but just at the sort of right-hand side, a couple of small detractors. Absolute return on active currency. These are the sort of more defensive asset classes in the portfolio. So in an environment where lots of the sort of more economically exposed assets have done particularly well, it's not particularly surprising for us to see that these defensive hedging asset classes have been small detractors. We still very much think that it is appropriate to have these hedging positions in the portfolio, given that the dual mandate that we have in place. I'll turn now to page 7, and just to give you an idea of our overall economic view of the world and the direction we think it's heading. We remain about as optimistic on the outlook for good global growth, good economic performance, certainly over the medium term, than we have been perhaps ever in terms of the 12 years or so that we've been managing our multi-asset funds. That expression of optimism, it's made in the full awareness, the full acknowledgement that the world is still clearly in the grips of a serious pandemic. There are clearly still significant hurdles to overcome from a health and a social perspective, as well as from an economic one. And that's partly in terms of how the vaccine is administered, the path of the virus, and so on. So if we're thinking about risks in the short term, at least, that's naturally the most obvious. But we do think there are a number of important reasons to be upbeat optimistic about growth prospects for the global economy. We do think that the crucial ongoing rollout of the vaccine will allow for a progressive normalization of activity to resume over the next 12 to 18 months. It's not going to be smooth. We should never really expect it to be. But we also think that the support coming from three sources will be particularly telling. One is supportive monetary policy for interest rates to remain very low. Another is the build-up, the increasingly large formation of savings that consumers and spenders may have at their disposal as economies reopen. And I think a third one, which is sometimes slightly missed, but which is really quite important, is the significant shift in the political and economic, and not to an unreasonable degree, the intellectual debate from that which was being argued in the aftermath of the financial crash a decade or so ago. Years ago, the debate was very much about how quickly we can achieve significant reductions in public spending, and the debate was very much about austerity. But we think that debate has largely been lost, and governments are now that much more willing to backstop spending in a really significant way. Clearly, then the key question is where we go from here and how we position the portfolio. The way in which we have the portfolio generally positioned at the moment is to try and capture that growth, that optimism we see within investment markets. So a higher weighting than we've had for some time in the likes of listed equities, an increased weighting in infrastructure. Like I say, that a lot of that is into some of those renewable and renewable related stocks and assets. We still also have a notable holding in property, but then balance with that the likes of absolute return, which again is that hedging aspect to the portfolio. So for us, the portfolio is very much tilted towards growth, towards optimism, but still very much one which we think is appropriate in an environment where we think there may be some form of volatility in the months ahead. I'll just pause there because I appreciate there's probably quite a lot there, and I don't want to overlook any questions that might be present in terms of our outlook or the positioning of the portfolio.
Councillor Andre.
Thank you for that. Yes, I do have a couple of questions. The first one, going back a little bit, you said the very nature of the Diversified Growth Fund means that a lot of the elements will be carbon intensive, but there has been a reduction. I think you mentioned a figure of 15%. How does that, just to put that in context, how does that compare to similar portfolios, if you're able to answer that? And my second one is very simply, I understand that, yes, we are looking over the long term. So are we talking of a period of sort of five years? Thank you.
So I think in terms of the time frame that we're operating on here, yeah, with specific regards to the climate change, I think this is a longer term issue, obviously, than the next 5 years. This is going to be a multi-decade transition. But what we're seeing at the moment is the acceleration of the way in which governments around the world are focusing their attention on climate risks. Now, part of this might actually come down to it being quite a convenient way for governments to stimulate economies by adding in fiscal support in terms of the spending plans, and that spending comes through in carbon reduction plans, carbon reduction spending. So if you like, it's quite a good way for governments to tackle the problem of reigniting economic growth by doing something which is then going to be beneficial for reducing carbon outputs. But this is something which we're seeing coming through as a clear and obvious investment opportunity in infrastructure, but across asset classes. But it's something which we think will play out over certainly a longer period than 5 years. Indeed, the work we're doing at the moment internally, based on our long-term return expectations, looks at it from a 10-year perspective and on from that, so multi-decade. Sorry, to your first point, sorry, I didn't quite understand the nature of the question.
Obviously, as responsible investors, we're very much concerned about the ESG part of any investment portfolio. And I understood at the beginning that in terms of the diversified growth fund, the investments do tend, because of their very nature, to perhaps be more carbon intensive, but that there has been a reduction. And I think a figure of 15% was mentioned. So just to put it in context for us, how does that reduction compare to, sorry if this is more a question for Hymans than yourselves, but just to put it in context, how does that 15% reduction compare to other portfolios?
Yeah, I think actually, without wanting to duck it, Tom, you may have a view on that.
It's okay if I come in. I suppose one thing to note is in terms of the reporting that we provided previously, I suppose one of the issues in terms of comparing a diversified growth fund is there isn't a kind of benchmark that's out there. So when you invest in equities, you can compare a portfolio to, say, the market cap benchmark, the global index. For a diversified growth fund, because it's kind of trying to beat cash, cash plus 4% or around about that, investing in a diverse range of asset classes, there isn't the same kind of benchmark comparator. So in the analysis we provided, we compared it to that equity index, the global equity index, which I suppose isn't a direct comparator in the same way. So that can mean that some of the positions that Baillie Gifford take might look magnified because they're looking to invest in diversifying areas. So I suppose that's one of the reasons. However, if I don't know if Tom or Barry, you might be able to touch on a couple of specific stocks. For example, RWE was flagged as one where it's a small holding but comes up as a big carbon position. If that's all right, Tom.
No, yes, thank you, David. The way it's fairly consistent across all of our portfolios that carbon exposure has been coming down over the past years, and that's true of diversified growth. It's also true of the equity portfolios, which we also manage for Access. And I think the reason for that is that if you're looking out over the long term, as we are, we're looking for opportunities to invest, and we're also looking at the risks of investing in companies for the long time. And essentially any asset or any business that is exposed to carbon risk, whether that's in the form of a tax or change of societal attitudes or something, that just does not make it such an attractive investment over the coming few years. So naturally, we've been moving away from those because, just say, we simply can't see. Or we can see the risks of being heavily involved in carbon. So we don't have an awful lot. We have no exposure in mining businesses, for example, in most of our portfolios. And in diversified growth, more of the investments have been going into infrastructure that will support a lower carbon future, such as the renewable funds. So yes, so that's the risk element of it, and the opportunity element is that these businesses, which are part of the transition, should be better, safer investments in years to come. So there's been a natural tilt away from carbon risk towards companies that are part of the solution and not part of the problem. That has reduced the carbon, and we think it will lead to better investment performance in the future. Does that answer your question?
That's very helpful. Yes, thank you.
Councillor Quigley.
Thank you. As a newbie, you may have answered this in previous meetings, but I know as a company you had around 400 million invested in oil, gas and coal several years ago. Is there any oil, gas and coal investments in the diversified fund? And it's not a catch you out question, it's just I think we need to know an answer to that.
There is a very small element of oil, gas and coal exposure which comes through some of our internal funds. The number is very small. I don't have it to the top of my head, but we can certainly get that number. But again, that is a number which has been progressively coming down over the years.
I think in the analysis we did, Barry, I think we were showing around about 4% had some degree of ties to fossil fuels. So it's
Yeah, I mean,
reasonably low in terms of the overall allocation.
yeah, exactly. And that's where you've got companies like RWE, which we hold within the infrastructure allocation. And I mean, that's a really interesting case in the sense of, you know, there's a company which is at the moment one of the biggest greenhouse gas emitting companies, as identified by, I think it's the Climate Action 100 list. But our engagement with RWE and our understanding of the direction in which they're traveling, to the points Tom made in terms of the transition they're making towards renewables and the sort of phasing out of their greenhouse gas emissions, that is something which we will take a view in terms of the long-term opportunities outweighing the current ESG risks, and the way in which RWE is going to transition over time will be beneficial for that as a company and also for the DGF. So again, I would expect that number over time to start to come down further.
And sorry, an additional one. You've nothing left in BHP Billiton. You no longer invest in them.
Not that I'm aware, but again, I can clarify that in case it just comes through in any of the underlying BG funds, but I'm pretty sure it doesn't.
I don't believe we do, no.
Thanks.
Any other questions? Yes, Barbara.
Yes, I think you may have partly answered my question with respect to engagement, and to what degree do you scrutinize the policies and the strategy of these companies with regard to carbon emission reduction? And are there written policies available from these companies for us to review? And also, in your calculations of carbon emissions, to what extent do you include scope 3 emissions and also offsets?
So the approach we're taking to engagement for climate issues, as we do across all areas of governance with the areas we're investing in, is very much based upon the genuine principle of active approach to share ownership rights and responsibilities. And we do look to identify the issues within the holdings that we think are going to have a material impact on shareholder value. We will look to participate in constructive consultation. We have regular meetings with management, with boards, with funds that we hold. We're finding that companies are themselves getting a lot better at articulating the way in which they are factoring in ESG considerations. Climate change, again, being one of those prime concerns that we express to our underlying investments. It's interesting, obviously, within a diversified fund, ESG factors are relevant across everything that we do, but they're relevant to different extents with different asset classes. The kind of factors that we're looking to consider when we're talking to clients from an engagement perspective, obviously things such as the company, the fund structure, their costs, their operational performance, their corporate governance, their risk management, internal controls, their own approach to CSR, to corporate social responsibility. Sometimes we are working with other institutional investors to address concerns. In terms of the disclosures, certainly from the developed market exposures that we have, they are really quite open now. They are very much aware of the scrutiny that they're under, and so the public disclosure of them is that much more reliable. I'm not sure whether we have them collated anywhere, Tom. I'm not sure if you know that.
I know that our ESG team will certainly have details of all of the disclosure that the companies we invest in for you have on these topics. And as Barry said, most of the companies are certainly getting a lot better at disclosing this. And this is one of the first conversations we have with companies when we start engaging, is to get them to give more detail, more data about their carbon targets. So at least you've got a starting point from which you can measure them to see if they're performing, how they're performing against their peers. So yes, absolutely, getting good disclosure is the first priority, because that's where you know where you start, and then we can engage from there. And most companies are getting better. And if they're not, then that would raise all sorts of alarm bells about whether we could continue to hold them. In terms of level 3, that is a good question. The challenge with level 3 data is that an awful lot of it in the past, or an awful lot of it is estimated, it's incomplete, a lot of it's historic. So it's interesting, and it gives you sort of an insight into what might be going on, but it's not accurate enough to be relied upon. Now, I would say this data is getting better and better all the time, and we're encouraging companies to look at this and improve it, and how they monitor and measure that. So it is getting better, but it's at the moment the numbers are still, slightly all over the place.
Any other questions? Yeah. Joe? Or...
Could you comment on the offsets? The offsets?
For the companies?
Yeah.
Yeah. Well, our view on offsets, certainly for Baillie Gifford as a business, is that we're better off not emitting the carbon in the first place. So we think just emitting all the carbon and then, buying your way out of it through offsets is cheating, really. So we prefer to see the companies doing something to either, cut their emissions or introduce technologies that do reduce emissions in general. So, we've had long investments in the equity portfolios in a company like Tesla, which is, electrifying the car industry and causing huge falls in carbon. So offsets are not something we've taken a good look at for some of these companies. And as a business ourselves, as I say, we think it's probably cheating. Although I would say Baillie Gifford does do double offsetting of its own carbon, but at the same time, we're trying to cut our emissions in the first place.
Yeah, the only other thing I'd add to that is we do know that, from the engagement we've had with certain companies, again within the infrastructure holding, is that some of them might be required to use carbon offsets to meet their net zero targets. But again, that's to Tom's point specifically, that's something which we are engaging with them to try and promote them towards thinking that the offset is actually not as good a solution as actually just reducing the carbon output in the first place. So we're aware that certain investments within the portfolio will require offsets, but that's something which over time we would expect those companies to actually be reducing their carbon output rather than just targeting net zero by purchasing offsets.
Thank you. Anything else? Joe? Oh, sorry.
Sorry, I might be repeating myself. After Debbie was asking about the deadlines for going sort of neutral on it. So you don't have a set deadline for that as a business, to be completely unreliant on the carbon and be carbon neutral, dependent on the investments. Who would set a deadline? Is there anyone at all that sets deadlines for that?
I think I missed a crucial word there. Sorry, at the beginning of the question. Sorry.
So about the carbon neutral offsetting and deadlines, and about not investing in it at all. Is there any kind of deadline that you would, so that we're not relying on it at all? Is there any deadlines that anyone sets, whether it's the company itself or governments, or what are we aiming towards? I just don't see an actual aim to cut that quick enough.
Yeah. So, well, I've got one part to the answer, Tom. You may have something equally. So when we're talking to individual companies, it's really seeing, you do take it on a case by case perspective. So, but obviously there will also be government set targets in place from a sort of national output perspective. But yeah, when we're talking to the likes of RWE, or when we're talking to the likes of American Electric Power, they are setting out clearly themselves the guidelines and the targets which they are setting, and our ability then, our responsibility is to actually scrutinize their progress towards reaching those targets. So it's not that we're setting them the target themselves, but we're observing the target they've set and how they expect to go about achieving it.
And I just add, a very common date for being carbon neutral is 2030. So a lot of companies who we invest in have set that target. Some are earlier than that, particularly for what I think the ones who find it easy. So some of the technology companies. And if anyone's significantly later than that, then that would cause questions to be asked. But no, 2030, if you want a number that is quite a common target.
Okay, so as an investor, can we set that as a target to say we don't want to be reliant on that at all? And you think any company that's with it, do we have that power?
I think that's a good question. We think that if a company is not addressing the challenges of becoming carbon neutral, then we would be asking them why not. And if they didn't have a sensible answer, where they weren't making progress one way or the other towards it, it may not be 2030 for any given company. It may be a bit sooner or a bit later. But then I don't think we would be investing in that company. So hopefully it would just come out as a result of our investment process and just wanting to find good investments for you over the years. And then we would come to you as a committee and report to what we've been investing in, and tell you why and justify, hopefully, why we're continuing to hold these businesses. It may be, and I would expect this to become an even more important part of our analysis in the future.
Yeah.
Sorry.
Can I just jump in?
Then,
yeah, just very quickly in response to Councillor Christensen's, Claire's comment, we don't have locally as yet a target date for carbon neutrality as a pension fund. One of the key issues that we do have to work towards is developing our ESG RI policy internally to set our own beliefs and structure going forward. And it's something that is very key and we are very much aware of, and is something that's on the work plan. Part of our review of our next investment strategy statement, which will be leading on from the valuation at March 22, will include a review of the investment strategy, and there will be a lot of work that we will be putting in to developing our own internal ESG RI policy with our own standards and our own target dates, which we will then be engaging with our fund managers to ensure that we can achieve. So it is something, Steve and Barbara, I'm nodding very close over to them, something that's been on the cards for a very long time. It hasn't been able to be a number one priority for us because of so many other things, lack of resources, etc. But it is very key to our thinking going forward, and we're working with Hymans Robertson to look at our strategy. We're working with board members and committee members. We will be working to develop those, linking into the council's climate emergency declaration, and then we can set our targets for carbon neutrality. I think the key issue that we've identified previously as a belief is that we prefer, as a fund, engagement rather than divestment, but that's something that we need to formalise and work through. So, I mean, as Bailey Gifford mentioned, RWE, one of the biggest carbon contributors, but have really good plans for transition. So, do we accept, are we happy as a committee, and we haven't had this discussion yet, that the future plans outweigh the current carbon risk and we're prepared to take that step forward? Or do we say, actually, no, that's not how we want to do it? We haven't had those discussions, but they're on the cards to follow, if you see what I mean.
Yes, no, absolutely. We'd be very happy to take part in that if that would help. We had a conversation with one of your fellow Access members just last week, and along with some of Emma and David's colleagues as well, who are in the same position, talking about their engagement strategy. So very happy to contribute to that as and when, if it helps.
Councillor Churchman.
Yes, my question concerns China. As one of the, I think it's India and China are still the biggest polluters in the world. What sort of investment do we have directly in China? I understand Chinese tentacles stretch into almost everything now, but it does worry me that if we invest in some of these companies who individually are making an effort to become carbon neutral, however, what about the political aspect? And I'm thinking of Hong Kong and I think the word is Uyghurs, that I don't know how to pronounce that. Just where do we stand here? And certainly as a nation, as a polluter. Thank you.
Yeah. So China, again, is one of these huge and growing questions within the investment team for the multi-asset team. You know, the starting point that we take with China with regards to the Diversified Growth Fund is, you know, China, you know, it's roughly 20% of global GDP, a greater proportion than that of GDP growth. And about a year ago, 18 months ago, we were of the opinion that quite simply the level of China exposure was underrepresented in the portfolio. So that's the first significant reason to have the exposure that we do. We have exposure to Chinese equities, Chinese domestic equities. We have exposure to international Chinese equities, and we have exposure to Chinese government bonds. And so as a total, it probably does account for around about sort of 18 to 20% of the total. The amount of exposure that we do take and how we get that exposure, clearly that is an ongoing question for us as active asset allocators. And that is the question we're constantly asking ourselves. We do think at the moment the type of exposure we have, the domestic Chinese growth with a very good sort of built-in cushion of outperformance, alongside the international equities and the Chinese bonds, is really quite compelling from a return perspective. But we do recognize that China has significant ESG challenges. There are challenges which come with investing in China. On the one hand, you have a country undertaking profound beneficial change, lifting hundreds of millions out of poverty in recent years. Strong institutions, capable leadership, growing presence on the world stage, often to be seen giving support to worse off nations. On the other hand, that support often seems to come with strings attached. The human rights record is often called into question, and the Uyghurs is something which has been discussed ourselves as a team. Also, the rapid urbanization is having a substantial environmental impact. Now, I appreciate that again is a very sort of high-level brief summary of the complexity of investing in China, but at this point, we've chosen not to exclude China from the opportunity set. It is making progress. And as it continues to open up to global investors, the scrutiny, the challenge which comes with that will, in our opinion, continue to drive progress in a lot of key areas. So Chinese exposure significant within the portfolio. We think it's reasonable and justified, although that is not a set in stone case. And if we think that there is a significant deterioration in from either an environmental perspective or a social perspective, we don't have to be invested in China. We can withdraw the assets from those investments.
Just like to come back here. I understand that China holds 60% of the world's debt. Could you please explain, possibly for the members of our committee, exactly what that means? Thank you.
Well, that means that where China have chosen to hold a lot of its reserves is in the debt issued by other economies. So to be honest, I didn't realise. I don't know where that 60% number comes from, but I do know that China has government debt of most developed markets. So the likes of the US, it's a large holder of US Treasuries. It's a large holder of European government bonds, of UK government bonds. There may also be an angle to that question in terms of the amount of internal debt which China has, and the way in which a lot of the economy has been driven by the opportunity to access leverage. But again, that's something which China, we think, is really quite competent at handling. So it does put China in quite a significantly strong position in the sense of it's got a lot in reserves. But again, that's one of the reasons why we think that China is a reasonable place to have some assets invested in the portfolio, because there is a lot of underlying support for the economy. Did that answer the question in the sense of is the 60% number? Can I just check? Is that referencing the possibly the debt that China holds in terms of its overseas exposure to other government debt?
I'm sorry, I didn't.
Where's the figure of 60%?
Well, this is why I'm asking. It's something that has been told to me by somebody who knows what they're talking about, and I'm assuming that they hold 60% of the debt across the world is because their investments in 4 places like South Africa, where they've lent money, in other words. And this is why I'm asking you, do you know if this is correct? And what is that debt comprised of? Is it just the fact they've lent money to everybody to create, well, I mean, in Sri Lanka, for example, they built a big harbour, which they now, of course, can't afford to pay off. So does that form part of that 60% debt? I'm sorry, I am fishing as well. Thank you.
No, that's fine. It's quite complicated, and it also gets very nuanced as well. And also the data is not entirely clear. But yeah, they are big buyers of debt, both in the public market. So the US government owes the Chinese, billions and billions and billions, because the Chinese have been buying US treasuries for many, many years. So how that's going to affect the relationship between the Chinese and the Americans, and also between all the other governments who have sold bonds to the Chinese, so the Chinese are lending them money. That will be interesting to see how that plays out. Yes, and the building ports in places like Bangladesh and parts of the Big Belt and Road Initiative to to expand global trade from China, across these parts. On one hand, yes, it's good that global trade is increasing. On the other hand, if it's not just lending to help them build a port, but it becomes slightly coercive, and they can't afford to pay it back, then yes, that does raise other questions. So as I say, it's complicated, and it ties up the sort of dual aspect of the Chinese expansion that. Most of it ought to be extremely beneficial. Global trade is a good thing, not only for us, but also for them. And they know that. As Barry said, they're lifting, hundreds of millions of people out of poverty. But, when it comes down to using that for political power, it's another matter altogether. And that's just something we have to monitor and keep an eye on. But I think you're absolutely right. The Chinese are a big part of the world economy. They are only getting bigger. And it's something we're spending a lot of time trying to understand.
Thank you. I think we'll say thank you very much to Tom and Barry.
Good. Thank you very much. Lovely to see you again, and I hope to see you in person next time.
Cheers. I think Barry is freezing occasionally now. Obviously, okay. It's time up on his clock.
Superb. Thank you. Thank you very much, everyone, for your time and questions.
Thank you.
Thank you.
Thanks. Bye-bye.
Right, so moving on the agenda, item 11 is the work plan, which you've got attached to the back of your document. Joe.
Thank you. This is very much a working document setting out key items that are currently on my horizon in terms of work plan for the Pension Fund Committee and the Pension Board. It is not complete. There are requirements to add in a couple of events in terms of the development sessions that I've recently booked on the 7th of September for governance decision matrix and the 6th of October for risk management. Some of those items may drive additional actions on the work plan. Some of them may take things off the work plan, who knows? Let's keep our fingers crossed for that. But you can see it is quite a busy period. There is a lot of things that we need to be doing and a lot of things coming up on the agenda. One thing I would draw members' attention to is there's an Access Joint Committee meeting highlighted in red or bold or dark, or whatever it is on your screen, on the 6th of September. Councillor Jarman is unable to attend that. We're anticipating at the moment it is a face-to-face meeting in London. I've not been told that it's not otherwise at the moment. So I will be need to have a conversation with Claire about whether you're able to attend that in Councillor Jarman's place. But I'll catch up with you outside of the meeting. There are development sessions listed at the bottom of the report. I'm hoping to get access, members from the Access Support Unit to attend either as part of the 24th of November committee or as a development session in the early part of November in addition to the committee cycle. And again, there will be a lot of development to be undertaken in terms of the triennial valuation that happens as at the 31st of March 22. So from November 21 until November 22, there will be actions that need to be undertaken on that, not least bringing you the results and explaining what the results mean. Again, it is a working document. It will be updated. If there are any things on there that you have questions on, or if there are any things that you think are missing, please do let me know and we'll build them into the work plan.
So any quick questions initially on that section? Yep, Barbara.
Yes, just a question really on the responsible investment. We talked about having workshops, and in the pension board meetings of the 7th of July, we did discuss this, and I suggested, and the board agreed to put forward the idea of accelerating, because resources, small fund resources are a problem to get things done. And I offered to lead with a councillor, possibly an officer, to put together a workshop on responsible investment, because it's the board's opinion that we are very far behind on this. Councillor Richardson's question about setting a carbon footprint number, it's best practice. Most funds do set their own carbon footprint number. We should be dictating what we want to invest in, and there's an awful lot of work. And the more webinars I go on, the more I don't know about it. And there's an awful lot of work, and I think this is something that we need to accelerate, because it is a serious financial risk to the fund not to have a strong responsible investment policy and to act accordingly. To know what the committee thinks about, kickstarting, putting a working group together on this.
I'm open to comments. I think given the question was specifically against Councillor Richardson, I should give her the chance to respond first.
Well, that sounds like something a good way forward, because that's what I wanted to know, obviously being quite new to this as well, that we don't have that target, that perhaps we need to investigate it further just to see where we are and how that is achievable. So a working group would get us to that answer. Thank you.
Would you be happy to lead that initiative then, Claire? Yeah. Good. So can we invite any members who'd like to be part of that initiative to contact Claire directly, and I'll leave her to take that initiative forward. Thank you. All right.
Yeah, it'll be a question I never get bored of asking. Is Joe gave me a very good answer yesterday, but I think it's one we need to find a proper solution to. Is why is none of the pension fund invested on the Isle of Wight? And I know it's because we say the returns aren't good enough, but it's self-perpetuating. Just going on Barbara's point, is we need to be very careful about using the terms carbon zero and net zero and carbon neutral, because they don't actually mean anything at all. It's carbon reduction should be the thing we're looking at, because it's quite easy to say, you know, 93% reduction in carbon emissions means there's only a 7% requirement for the planet to absorb the other 7%. That's a genuine reduction. If it's 50-50, you're probably coming up with a fairly nonsensical scheme, and there will be schemes that claim to be carbon neutral, which actually increase carbon emissions but rely on some unproven technology. So I think we need to be very, very careful of that. And to be honest, it's nice to hear that people are saying that, because ethical investment is a bit of an oxymoron, I know, but we seem to have a very committed group of people on the screen there that want to make sure we are responsible investors. And the last bit was carbon offsetting is going to be the next PPI scandal of the financial world, I think, so just to be careful of that. Thank you.
Thank you, and thanks, Richard, for bringing that up. Firstly, I would say that the Isle of Wight Council Pension Fund investments are for the benefit of the members of the pension fund. There are 16,000 members, which are predominantly on the island. So that's about 1/10 of the island's population. It has an interest in the Isle of Wight Council Pension Fund in the LGPS. Investments in the pension fund need to be balanced to generate a suitable return for the pension as a whole, and a risk part of a balanced risk strategy for that investment. The fund cannot put its capital at risk on speculative investments in any shape or form. And with the greatest respect to the Isle of Wight, there are very few proven local investments that would give the necessary return that we need to seek. When we spoke yesterday, Richard, we spoke about you spoke about housing projects on the island. Again, housing projects could be quite profitable, but we'd need to have a demonstrated return and a demonstrated success factor before we could put the pension funds at risk on that sort of investment. So it would be very unlikely that we would any housing development by the Isle of Wight Council or on the island. It's unlikely we'd invest in the second chance, but there's more likelihood, given proven track records effectively. But it is part of a considered balanced investment strategy. And as I said, you know, the money is for the members of the pension fund, not to prop up the Isle of Wight Council's budget and activities. I'm not sure if Emma and David want to add anything in terms of local investment, but again, we are quite a small fund, so we do need to be aware that what other local authorities are putting in from their pension funds is in value terms is very much different to the amount of value that we could put in locally. But I'll pass over to Emma and David if they've got any comments.
And it's a widely debated topic across public sector pension schemes, whether they should invest in local investments. And currently the fund, you do not invest any money directly. All your money is invested through your investment managers, and you delegate the decisions to them to seek out the best opportunities for you. And they will look at the market as a whole. And if you are considering a local investment, can you prove beyond, you know, kind of reasonability that it is the best investment out of all the local housing opportunities that are available? Because as Joe said, your obligation as trustees is to the members of the fund and the assets in which you invest, not to be biased towards the Isle of Wight. It is something that can be considered, but it's usually through your investment managers when you have such limited resource as well, because these sorts of direct investments take up a huge amount of time and analysis that would need to be done in order to prove that it was suitable in the first place. But you are relying on your investment managers to seek out those opportunities, and they will consider local housing, residential housing. You don't have an explicit mandate for that, but it's something that might develop through your property mandates or through even the access pool over time. But one, you don't have the internal resource to analyse these opportunities properly, and two, you've been delegating these decisions to your managers, who are best placed to be able to make those risk-adjusted decisions across the entire market. That's not to say that it would never appear, but it's the reason that it hasn't been so far.
And just one thing is, we'd have it. So one of my other clients is the Strathclyde Pension Fund, and they do have some more locally focused investments. But even then, it's all through institutional products where there's an external fund manager that runs and operates that, and they have 2 dedicated officers within the fund that their full-time job is to review and monitor those portfolios. So, there's a big governance requirement in kind of monitoring those types of investments. And also that even with that fund, they still will utilise institutional fund managers. So there's still a challenge in trying to create these types of opportunities, but also have something that's investable for a pension fund as well.
And what's that Strathclyde Pension Fund?
They're 25 billion, so they typically allocate between 20 and 50 million pounds a time to some of these local investments as well. So there's a scale factor.
Thank you. I know Preston Council, which is about the same size as the Isle of Wight, have put 100 million into their local economy. So it's just a warning, I suppose. I'm just going to bore you all, but not myself, asking this question regularly. And I would challenge. I'd accept today's answer, but I would say we do continue to challenge, because, and don't take this the wrong way, but investment managers aren't going to solve the problem in a local council or in terms of climate change, because it's not your job. Your job is to make money. And I would also challenge that the risk of investing in something like RWE that has a very high carbon exposure is probably more risky at the moment than investing locally. So that's not a question, it's just a statement, and I will avoid making statements on here on in. So thank you.
I think we'll remain open to the idea. That's the key thing. We are open to it. Councillor Andre.
Just in addition to that, I think it's probably worth making the point that the pension funds that are actually paid out to our members that are drawing pensions will obviously contribute to the Island Pound.
Can I just say something? Yeah. We actually we pay out about £1.8 million a month into the Isle of Wight economy. So we are doing actually some good for the Isle of Wight. I know it's not investment, but it's actually helping with, yeah.
Thank you. Any other questions under item 13? No? Good. Then the next item, 14, is to consider passing a motion. I won't read it all out. You can see it all in front of you, finishing with the phrase, interested in disclosing the information. Do I have someone to move that motion? Thank you. And duly seconded. Everybody in favour of that? Anybody against the motion to exclude? No? Good. So that's duly passed. I think at this moment we're going to have